Okay, I'm going to go ahead and get started. So welcome everyone who's joined. We are recording this as well. So my name is Pigeon. I'm the Chief Operating Officer at Hobbs Group Advisors. We at Hobbs Group Advisors are a financial planning focused firm, wealth management firm. We have three core services that we provide. One, our main, our first service that we provide is financial planning, where people come to us to help them solve financial problems dealing with retirement, life-changing events, job changes, saving for some particular goal like education. So that's financial planning. Our core service is what we call wealth management, which is where we manage portfolios for individuals and institutions, but we incorporate financial planning along with it. So we think that's a differentiator in the service that we provide for wealth management for our clients. And then thirdly, we work as a retirement plan consulting firm. So we help with 401ks and other forms of retirement plans for both for-profit and not-for-profit entities. So with that brief introduction, today's webinar is about a very timely topic, which is investing during a market downturn. I think you can define our current market environment as a market downturn based on the results over the first half of 2022. So we're going to talk about perhaps some charts and graphs, because we love charts and graphs in this business, and really, which is supposed to reinforce some of the recommendations that we're going to provide during this webinar, but also the recommendations that we're giving to our clients in real time. So with that being said, I'm going to start down my slides. So we have 8 principles and we have 9 opportunities at the end. So you have to stay till the end to get some recommendations on some things that you possibly can do to help. So just some principles. You know, it's not a popular thing to say, but it does pay to own stocks. And I've got some charts and graphs to show you that. Pullbacks or corrections, volatility in the stock market does happen. It's quite normal. And if you look at the history of it, that can give a little bit of some comfort to maybe what's to come. The reason that you see and you hear investing for the long term, when we talk about investing in stocks, which is typically what we recommend as a vehicle for providing growth for the long term, is that there's data that supports that, right? But that is a long period of time, right? When we look at short periods of time, one of the goals is to move our view to a longer period of time, and that could be, how long, if you're in retirement, how long is your life expectancy, right? If you're in accumulation mode, how much longer until you actually do, intend to retire? Things like that, so that we try to take the eye off the short term and look at the long term possibilities. When we talk about higher rates, the Fed, it's a hot topic right now. Interest rates, inflation. Some data came out this morning about inflation. Just because rates are rising does not mean that stocks are going to do poorly. But there is some volatility that comes with it, which is on number 5. And there also is some volatility during midterm election years, which we are in. The idea of non-recession bear markets, once again, there's discussion about recession, whether we will have recession in the United States or not. Non-recession bear markets are typically more shallow, meaning they don't go, the downturn does not go as deep, and they're rare. And the idea of timing markets is really never a good idea. In my 20 years of doing this, I've seen way more harm than good for people that try and time markets, and I've not seen it done successfully. And then at the end, how do we make lemonade out of lemons? What are some positive things that we can do that aren't related to market timing in a situation like this? So I'm going to talk a little about some of the charts and graphs here. Spoiler alert: stocks. You've really benefited if you've owned stocks over the last in this case, the last 14 years, right? So since 2009, the bottom of the bear market of 2008, the Great Recession of 2008, 2009 was technically March of 2009. Since that point in time, you've seen a significant rally in the stock market. Right now, there was a huge drawdown that took place in 2008, but you see there are these periods of volatility along the way. What I would say to that is that oftentimes, and this is a psychology thing, is that we forget about all of the growth that has occurred from the stock market, especially when we see negatives. Right? I think the data says that we feel the negative about 3 times more than we feel the positive. But we still need to remember that you've benefited from owning stocks if you've owned stocks during this period of time, which almost all of our clients have. This is an interesting chart, and this goes back to 1926. So we just showed you a kind of a recent data point in the last graph. This one shows you how many more years of positive returns we have versus negative years since 1926, right? We have far more years on the right side of this graph showing positive returns than we do on the left side of this graph. So this is why we point to the odds being in our favor over a long period of time, right? Because we have greater probability of making money in the stock market than we do losing, even though losses do happen. The idea of market pullbacks, they happen, right? Market volatility happens. This chart talks about the number of 5% drawdowns per year since 1980, right? You see, and this chart is through March 31st. So this is not, as up to date as where we are currently in the year. But you see that these fluctuations happen. It just so happened that last year, we didn't have very many of them in 2021. Right. In 2020, we had pretty significant drawdown because of COVID. In 2021, not so much. So now we are experiencing more volatility in 2022, but that happens. And this is an interesting chart. It deals with annual returns and intra-year declines. Excuse me. So the idea of where the stock market perhaps was at its lowest, which is often these red dots in the negative, and then the gray chart deals with where the stock market finishes for the year. Okay, and so what this means is that you have years where, for example, currently in 2022, the stock market's down somewhere around 18 to 20%. Once again, this data is not real time, so I think we're somewhere around 20% drawdown in the S&P 500. Where will we finish between now and the end of the year? That is the question. But if you look at these drawdowns that have occurred in the middle of particular years, you see that oftentimes, once again, we know that there's odds are in our favor that stocks will end positively in any given year, 7 to 8 out of 10 years historically, right? Where will we finish? There's lots of I think there's lots of history to the stock market actually performing better. And where it finishes at the end of the year is very different from where it can be in the middle of the year. So once again, the volatility can be quick, both to the upside and the downside. This is the chart that we use quite often to talk about long-term. This is the frequency of positive and negative rolling period returns. And what that means is if you invest your money over a 1-year period, as I said, we've got 8 out of 10 times the stock market has been positive. But if you look, as the longer you are invested, the greater your odds, right? So this is the long-term, this is very much the long-term mantra of stock market investing. 3 years, we're closer to 90%, right? 5 years, it goes up a little bit higher. 10 years, high 90s. 15, 20 years, we've never had a 15, 20-year period of negative stock market returns in the United States. So this is the idea of staying invested, obviously, and making sure that you're your investments are aligned with your time frame. Now, time frame can mean different things to different people, but that's part of the overall strategy, which is really, even if you're in retirement or you're nearing retirement, you need to have a plan for how you're going to draw out your investments, and I'll talk a little bit more about that in a minute. So, once again, time horizon. We talk a lot about time horizons, powerful tool for managing volatility. You see over a 1 year period, we have more volatility in stocks, less volatility in bonds. In a portfolio where we combine stocks and bonds, which is the idea of construction of a portfolio, we can reduce the amount of volatility, the amount of fluctuation in your money over a 5-year, 10-year period, in a 20-year period. You see in a 20-year period, we're positive in all these portfolios. You see over a 10-year and a 5-year period, the idea of adding bonds. Most of our clients are not in all stock portfolios. So how do we mitigate against some of that risk over a 1 year, 5-year, 10-year period of time? And the idea of compounding growth, which can occur, and this is from 1950 to 1921. And this is an interesting chart because as the Fed is hiking interest rates, right, which is an intent to slow down perhaps inflation and slow down demand in the U.S. economy, the idea of raising interest rates, the question is, and part of the toolkit of the Fed is that to get interest rates to a point to where they can also use them as a tool to cut interest rates, right? If we have for example, a recession that occurs, the idea of hiking interest rates now is to generate enough to slow down the economy, but also to have enough of an interest rate, because we were at zero interest rate for so long, to actually stimulate the economy if that's needed. You can't do anything to stimulate the economy if interest rates are at zero, right? So if short-term interest rates are, let's say, 2.5% to 3% at the end of this year, then if the Fed needs to cut interest rates to stimulate the economy, they can. So that's a positive. It doesn't necessarily feel like a positive, but what this means is that once the Fed is done raising rates, they're probably not too far from cutting rates. And that's what this chart tends to talk about. And cutting rates is typically good for stimulate the economy and the stock market. But even if rates aren't cut, right, higher interest rates do not necessarily mean the stock market's going to perform poorly. So this chart speaks to stocks in the years following the Fed's decision to start raising rates. As you can see here, there is only one period of time where the stock market was lower in the year preceding the Fed starting to raise rates. Every other time period, 1997, 2015, 1999, 2004 was positive. The idea of rising interest rates does not necessarily mean that the stock market is doomed. And then this does speak to this year, right? We are in the second year of a presidential cycle. We are in a midterm election year. Historically, these years have more volatility. So you see first year in office, you see midterm year, you see the pre-election year, and then you see the election year. And what we're showing here is the average intra-year drawdown, which speaks to the volatility, the roller coaster effect, which is typically higher in the midterm year. And then you see the average yearly return, right? Higher average yearly returns in really the pre-election year, which is next year, versus the midterm year. Now, this is on average. Obviously, every year is going to be different. But this does speak to the fact that there's a little bit more volatility historically in midterm years, which is the year we are in, 2022. So, and markets typically like post-midterm periods. So this talks about quarterly performance by presidential cycle. So this actually speaks to after the election, right? So Q4 of the midterm year, after the midterms already happened. This shows you rates of return in the S&P 500, which is the U.S. stock market, in the last quarter of the year, which would be the last quarter of this year after the election, and then the first quarter and second quarter of the following year, which would be 2023. The idea of this is there's more certainty after those elections take place. You know, politics tends to play a role in everything. So oftentimes I hear clients say, if this party takes control or this party takes control, the stock market will do better. What this chart really speaks to is it doesn't necessarily matter, right? There's just more certainty regardless of who wins the midterm election, who takes control of the House and the Senate. So that's a positive, right? And once again, this is historical. It doesn't mean that this is going to happen exactly this way, but it is a positive historical reference point. So the idea of stocks, and I think, if you think of all these charts that we've shown, that 8 out of 10 years were positive in the S&P 500, the longer time we have invested, typically the better, right? This just reinforces the fact that stocks spend more time in bull markets than they do in bear markets, okay? What that means is that when bear markets happen, they don't happen for nearly as long historically as bull markets, right? And this goes into the timing thing, right? We are in a period of time where the market is down. The question is, how long will that take place? And I think the answer is that we don't really know. But if we look to history, we know we've got better odds of being in a bull market again than we do being in a bear market for a long time. Okay, and this goes back to kind of looking at history. So non-recession bear markets are rare. So what that means is, right, and it doesn't appear, based on economists, the feeling is that the U.S. is not in a recession right now. Could we be in a recession? I think that's a possibility at some point. But the idea of a bear market when the United States is not in a recession is a relatively rare thing. And it typically means that there's a lower drawdown that occurs. So this chart speaks to the number of months where we're at a bottom on average with a bear market that's not in a recession, and the number of months of recovery once again, and then a return after that, after the 1 year low. And by the way, we can send these charts out to anyone. If you want to send us an email or put something in the chat box, we're happy to send these charts or this presentation to anyone who'd like to see it. So once again, the timing aspect of this is really difficult. We don't know how long this bear market will last. We know historically they last shorter than bull markets. So the idea of timing, and the reason that most of the time when our clients call and say, what should we do, right? Our June statement was awful. The answer is to, one, check your allocation, make sure it's right for you, which is part of our job for our clients, and two, to stay invested, which is not the answer that people want to hear sometimes. But getting out of the market is the easy part. Getting back into the market is extremely hard. What this speaks to is, over a 20-year period of time, and this is from 2000 to 2021. If you missed out on the 5 best days over that 20-year time period, your annual return is 2.5% less. If you missed out on the 10 best days, you're now almost half. Your returns are cut in half. You missed over the 15 best days, and you see where we're going here. We don't know when those best days will be. We know we have better odds, better days than worse days, right? We are in bull markets longer than we're in bear markets, where the odds are in our favor more times, 8 out of 10 years. This speaks to, I have never seen anybody time the market well. Okay. I've seen some people get out of the market and then the market goes down and they think they did great, but on the back end, when there's a recovery, you're not going to know when to get back in the market. I feel very confident about that because I've seen it done to people's detriment many, many times. So this is why we say to stay invested. This is why we say to own your investments for a long period of time and make sure they match up with what your goals are, which is a big part of our financial planning discussions that we have with our clients. So what are our opportunities? What can we do that's not going to, negatively impact us financially? Okay, so selling and trying to time is not a recommendation that I will ever make. for reasons that we just talked about in the last I don't know, 9 or 10 slides. So what are some things we can do? So really simple thing to do is, if you intend to make an IRA contribution, or if you're a company intending to make your retirement plan contribution, why not make it now? If you have the funds to do it, right, and your intent is to do it at some point this year, well, we know the markets are 20% lower than what they were, at the beginning of the year. We don't know what they're going to be a month or 2 months from now, but this is an idea of buying low, right? Buying lower. Could it go lower? Sure. But this is a lower point than it was before in January. So something to consider there. The idea of Roth conversions, and we've talked a lot about Roth conversions. If you look on our website, I think we have a couple interviews where we talk about the mechanics of that. And it's really hard to get into all of that on this particular webinar. But the idea of a Roth conversion, where you take IRA pre-tax money and you convert it, move it to a Roth, which becomes which is a taxable event, and that requires some tax planning. That being said, if you are intending to make a Roth conversion and you are planning on doing that, and we often schedule those with our clients, specifically our clients who have just retired and are waiting to take their Social Security, and their income is much lower now than it was when they were working. If the plan was to do some form of a Roth conversion this year, it makes more sense to do it now if their portfolio is down, because you're taxed on the amount of the Roth conversion. You can move over your exact same investments in kind, meaning you can move, if your portfolio is in a stock fund, ETF, or individual security, you can convert those same investments. And then what happens is, if and when you have recovery on your investments, that your recovery now is tax-free. Okay, so you've in essence moved over you've converted at a lower price point, and then had a recovery in the future that is no longer taxable. So, and the idea of backdoor Roth conversions, which is something that we talk to people about on an annual basis. Once again, there's some rules there. There's some ways you can stub your toes. So make sure you talk to an advisor about that. But the idea of doing those things that you were already planning on doing, perhaps accelerating those in light of the fact that we've got the markets down, right? Because there's a benefit for doing it while your investments are down. So that's an item we talk to our clients about quite a bit. And then if you have cash that's sitting around on the sidelines, you've been waiting, or you thought the market was high at the beginning of the year, certainly, once again, that's a possibility. And then the other thing that I talked about yesterday with a client, and we talked to our clients about, and we do as part of our portfolio management process, is to harvest losses, right? So if you own securities in a taxable account, taxable brokerage account, taxable portfolio, so what I'm speaking to there is non-IRA, non-401k assets, you can do something called a tax loss harvest. So what that means is, if you have a holding and you have capital losses on that holding, you can sell that holding, which generates a capital loss, either a short-term or a long-term capital loss. And then you can buy back, not that same holding, but you can buy back a similar holding. So in essence, you haven't lost anything, because you're just selling to generate that loss. You're buying something very similar, if not very, very close to it. Like in the case, if you have one S&P 500 index fund, you could buy a different index fund. And you have in essence harvest that loss. Your investment, if you do this simultaneously, is basically the same. You have not, there was no timing aspect to this, because you sell something and buy it back immediately, or you buy back something similar immediately. And therefore you have captured that loss, that when you sell something in the future, so you can take up to $3,000 per year in losses on your tax return. But also, if you sell something in the future, you have that loss captured, and it can stay on your tax return to offset any future gains. So you've in essence reduced your future tax bill by doing this tax loss harvesting maneuver. So that's something we're constantly doing in taxable portfolios. It does add a good bit of value if it's done properly, and it doesn't have any impact to your overall rate of return, right? So And the idea for in item 5, if you are taking distributions, right? If you're taking distributions from your portfolio, that's where you need to think about, where are you taking these distributions? What are you having to sell? Should you consider a different source to generate income? This is the idea of making sure portfolio construction for someone who's in retirement needs to have an ample amount of what we would say, bond or cash to pull from, right? And we call this spin methodology. So you can pull from those assets versus having to sell your stock holdings. Retirees should not be in an all stock portfolio. They should have a combination of many different things in their portfolio. If there is a situation where you may have to sell something that's down, in item 5, what we're really talking about is perhaps finding an alternative source to generate that income. But having an income plan is a big deal. So when we talk to our pre-retirees, it's really a matter of what assets will you use and when, and how do we design a portfolio that can support those distributions so that you're not having to sell stocks in a down market to cover any of your income. You do not want to be in that situation. So, in item 6, for people that are considering retiring, working longer, that's certainly an option. What we try and do from a planning standpoint is design a portfolio so that this is not something that you have to consider, but it is certainly something if you're planning on retiring this year, if you have the ability to work longer, that is a possibility to reduce pulling money out of a portfolio. The idea of rebalancing your portfolio in number 7. So what that means is, by rebalancing, typically that means selling the things that have gains, perhaps buying back certain items that are down. The idea of rebalancing is really a risk management tool. And what I guess the way I would speak to that is probably over the last 5 years, many of the large cap growth names, stocks have really driven a lot of the growth in the stock market. And so for people that have owned those, they really benefited. But what also happened is those particular holdings became a much larger percentage of their portfolio because of their growth, right? Because they did so well. So what we found is that many portfolios that have performed really well over the last 5 years were perhaps out of balance because of those winners that they held. So the idea of rebalancing is selling some of those winners and buying back things that perhaps have some value. In this case, we talk to clients about cyclical stocks and commodities, which we find are not very common in many portfolios that we come across. We use those in our portfolios. The idea of using hedging strategies. So that's not to say go make drastic changes to your portfolio, but it is an idea to look at your portfolio and make sure it's structured soundly. And if there is an opportunity for rebalancing, basically to get it back in line with what it was previously, that can be a risk reducing measure. And then the flip side is, what if you were very conservative? You could get more aggressive with your asset allocation if you have a long-term time horizon, right? So, and what I mean by that is that if we're saving for retirement, what I tell my clients is that what happens right now, if you are 15 years from retirement, doesn't really matter. It doesn't feel good, but the goal is to have, right? The goal is for that client to have the most wealth when they retire, which means we do have to deal with some of those fluctuations. I guess the positive to that is if you're still saving, you are buying shares. If you're saving in your 401k or IRA and you're doing it systematically, you're buying shares at a lower cost, right? We call that dollar cost averaging. But for people that get nervous, that's not the easiest thing to say, to get more aggressive. But logic does say perhaps buying low, since we always want to buy low and we want to sell high, that could support that, or at least taking a look at your portfolio. And then the idea of gifting. So for some of our clients who are looking at their estate planning, some gifting strategies can make some sense if your certain assets have gone down in value. Once again, you can gift those assets, and it's based on the value of the gift at that time. If you give shares of stock and that stock recovers, then the beneficiary of that gift gets to benefit from all that growth. And your gift was based on the amount you gave at that time. So those are some strategies to consider from a gifting standpoint. Obviously those strategies did not involve, selling out of your portfolio, cashing out anything. Those are things we don't recommend to our clients. But the idea of, obviously taking a look at your plan, taking a look at your allocation, taking a look at, your time frame. Those are always things that make a lot of sense. Just to put a plug for kind of our wealth management service, that's part of what we want to be doing on an annual basis for our clients. And oftentimes when you look at your long-term plan, if you look at your statement, it looks bad. And so it leads us to wonder if it's going to impact our long-term plan. Oftentimes when we run a long-term plan for our clients, even when their portfolios are down, it still shows, our system typically still shows that they're able to do the exact same things that they were wanting to do when the market was up, right? Because our software is going to look at over a long period of time and the viability based on markets, both good and bad. So the idea of looking longer term, reinforcing that longer term thinking with some sort of a plan behind it, can allow you to, provide some shelter in the storm when markets are doing poorly. This slide has all these disclosures that come along with this presentation. We appreciate you being with us today. Here's my contact information, our contact information. Like I said, if anybody wants to send us a question directly, we're happy to answer it for you. And if anybody would like the slides, we're happy to send those to you. Next month, I'll just say this, we're going to do a webinar on college planning. So this is the third webinar that we've performed this year. I think Garrett Strange, and these are all on our website, hobbsgroupadvisors.com. Last month, Garrett Strange did a presentation on retirement income planning and the methodology to that. I talked a little bit about that in this webinar. I think I did one in the previous month talking about Social Security. Next month, we're going to talk about college planning. And then I believe the month after that, we may have a guest talk about Medicare planning and Medicare supplement insurance policies. So be on the lookout for those. We thank you for your time today. Hope everyone has a wonderful rest of their summer. And like I said, if anyone has questions, we are happy to answer them. I don't see anything in the chat box. I hope I'm looking at this right. But Charlie, let me know if there's a question that I've missed. But we appreciate you all, and we will talk to you soon.